Earnings season is a key catalyst for markets this week. Our next guest has some key topics he's listening for on earnings calls this quarter. One of those themes is economic uncertainty. Here's what we've heard from executives so far this earnings season.
We see the spending patterns as being sort of solid, consistent with the narrative that the consumer is on solid footing and consistent with a strong labor market and the current central case of a kind of no landing scenario economically.
Overall, the U.S. economy remains strong, with inflation slowing and a resilient labor market, boosting income and supporting consumer spending.
We want to bring in Michael Reinking. He's senior market strategist at the New York Stock Exchange. Michael, it's great to have you here on set with us. Let's talk about some of the themes so far this earnings season, focusing first on the economic backdrop right now. We just played the two clips that we heard last week. This morning, we're getting some commentary out from Goldman Sachs and Bank of America, citing some signs of economic resilience. Talk to us then about what this signals then for the market's momentum.
Well, first off, thanks for having me back on. Yeah, look, I mean, so far we've gotten off to a pretty solid start from an earnings season perspective, right? We're getting pretty solid numbers from the banks, right? The general commentary about the consumer has been pretty positive. We haven't seen any big red flags, in terms of credit quality, right? So, from a broader economic perspective, we have, seen some moderation during Q3, but overall the economic activity has remained pretty positive. So as that kind of relates to earnings, that suggests that we should see kind of a reasonably positive earnings season as well. I think one of the key themes that we're watching for this quarter is that we're expecting to see kind of that growth gap between the megacap tech stocks and kind of the other 493 start to narrow. And I think we're kind of getting to that moment where this is not necessarily that inflection point for the other 493, but you want to start to hear the commentary get a little bit more positive about what's to come.
What's really interesting is especially what we've heard from some of the companies reporting and how investors are reacting to them with regard to the cost-cutting measures that they're instituting as well. And that's seeming like it's providing some of the relief as well. How much more of that do you anticipate to be a larger theme this earnings season, where we see perhaps a positive or upside move after the earnings are reported, but pointing back to some of the cost-cutting measures that are being instituted, either on headcount or even on some of the footprint in Walgreens' case that they operate? Yeah,
so that's something that I've been talking about for multiple quarters now, because you've seen companies kind of instituting this cost-cutting and focus on efficiency, right? And the point that I was sort of making was, as we start to see a moderation in economic activity, right, that's going to help to buffer the numbers, and I think that's kind of where we're at in that process. But I think kind of going forward, what it also does is really create operating leverage within these companies, right? So as you start to see the economic backdrop begin to turn, right, that's going to give them additional earnings power, and that's where I think that's how the street is getting to this kind of 15% earnings growth as we move out to next year. So you're factoring in kind of this soft to no landing kind of narrative, but you're also factoring kind of that operating leverage that businesses are going to have going forward.
And you talk about some of those, pressure points here for companies going forward, or maybe why we are factoring in still some of that solid growth. Where does the cost-cutting measures come in? And I guess in terms of how investors should be thinking about that, clearly it's not the same case. You can't kind of paint a broad picture across industries. So how should investors be looking at some of those plans from tech versus maybe what we're hearing from financials this week?
Yeah, so financials, right, that's been one of the real positives that we've seen, right? The expense ratios have been kind of pretty low, right? So that's been a positive in helping the numbers ultimately. I don't think you're necessarily looking for a lot of cost cutting from kind of tech, right? From that industry in particular, right? I mean, there's still like a big focus. I mean, I guess it depends where you are kind of within that tech landscape, right? But there's still kind of a big focus, kind of on that AI infrastructure spending and the CapEx spending. I don't think you're really seeing a whole lot of headcount kind of reduction there. I think it's more in the manufacturing side of things, the industrial side of things, where you're seeing kind of the headcount reduction and things of that nature.
What type of scrutiny do you believe we might see come forward from investors when companies are talking about some type of aggressive capital expenditure profile, either in the name of artificial intelligence or in the name of whatever the latest and greatest technology is that they believe is going to power their industry forward, that they have to hop onto now in order to reap the benefits later on down the line.
Right, and that's something, and I think that's really a key in terms of how kind of that AI and the tech trade, kind of really starts to kind of play out over the next couple quarters. We did start to see, last quarter where there was a little bit of pushback by the market, right? As companies were increasing their capex budgets, right? So you're starting to see a little bit of pushback if the market does really begin to kind of push back more aggressively on that side of things, right? That can create a little bit more of a bifurcation and lead you to kind of that expansion of breadth within the marketplace, away from tech. But from a tech perspective, right, those stocks have really just kind of traded sideways over the last quarter, right? And so you're still looking at 20% year-over-year earnings growth rates, for the third consecutive quarter, right? So those companies are trading at a higher multiple, right? But you can also correct via time, right? And just allow those companies to kind of grow into the elevated, with those high growth rates, like grow into the elevated valuations, kind of over time.
Great points. Michael Reinking, who is the New York Stock Exchange Senior Market Strategist. Thanks so much for taking the time here with us.
Thanks for having me.
Absolutely.